Yeah, so we're constantly getting pounded with this. Is now a good time to invest in real estate?
And specifically, is now a good time to invest into
commercial real estate?
Yeah.
In the form of self-storage or maybe even multifamily, but we're going to concentrate on self-storage because we have a rock star in the self-storage industry, Jacob Vanderslice. Welcome to the show, my friend.
You guys are you're too kind. Good morning and good afternoon.
So, just out of curiosity, how much square footage are you guys controlling right now? Do you know right off the top of your head?
We're at about 1.7 million.
Wow, that's a lot of boxes.
It's a lot of boxes. Yeah, a lot of metal boxes all around.
And empty wine bottles.
Man,
people save the strangest stuff. It's just
I really do.
Well, I mean, you understand the industry completely in all sectors, and the biggest issue is the rise of property values and the prices that you're having to pay for properties. What are you doing to, number one, find the good value add stuff, and are you just having to deal with a little bit lower cap rates right now?
Well, I think the challenge of deal flow is systemic across all of the asset classes that we all focus on, whether it's single family homes, multifamily, industrial, self-storage. There is a lot of capital out there right now that wants to be allocated to hard assets. The stock market's getting very long in the tooth. We're seeing very much a pivoting of capital from traditional publicly traded equities into private real estate vehicles. And with that pivot, we're seeing a lot of cap rate compression, and therein we're having challenges with deal flow. Most of the deals that we source are through relationships, broker relationships, direct to seller relationships. That being said, though, we're still paying more than we used to a couple of years ago, and that's universal. One of the challenges that we're seeing specifically in the deal flow front is there is an historically low cost of capital out there, and people are paying what we believe are very compressed cap rates because their yield requirements has gone down. It's, do you want to make a 0 or do you want to make a 4? And they say, well, we want to make a 4, we got to get money out. So what we're thinking that we're seeing in a number of the deals that we're missing by millions of dollars are buyers are underwriting to what may or may not be untenably compressed cap rates when it comes time to sell. So as you guys know, the model will tell you whatever you want it to. And if you're buying a deal and you want to be conservative and you say that deal is going to sell at a 7 cap in 5 years' time, and you make an offer based on those assumptions, you may not get it. Somebody else is going to come in and say, we're going to say this deal is going to sell at a 5 cap in 5 years. So they can pay exponentially more than the person buying the deal at a 7 cap in 5 years. So that is one of the many reasons why we're missing deals out there. We are still getting product. We're getting inventory that makes sense, that we believe has good risk-adjusted returns, but we're certainly not finding as much opportunity as we'd like.
Right.
Well, Jonathan and I had a local RIA subgroup meeting last night, and we're hearing that from the people in that room, the exact same thing, that they are constantly getting outbid, and then they're coming with cash. They're not looking to have any kind of financing, and that gets tough when you're trying to get into the commercial self-storage arena. It's hard to come up with that much cash. But you're right, we were having that discussion exactly last night, that there's a lot of capital looking for a home
and compressed timeframes to close. I mean, you usually see people like in the commercial space, 60, 90-day, due diligence. I mean, we're seeing more and more people closing at or inside of 30 days.
Yeah.
Crazy.
Yeah.
You can't do your proper due diligence in that short a period of time. They're just taking it, basically no inspections, so to speak.
Yeah, we were doing a lot of 60-30 contracts, and now we're doing more like 45-15 just to hope to be competitive. Sometimes 30-30, but that's not a lot of time to properly evaluate a $15 million acquisition, for example.